in a world where 70% of carbon emissions come from 100 largest corporations, I think it's time that the financial world becomes our ally in the fight against climate change. It wields immense power, has access to immense capital, and I think the motion allows us to put that to good use. A couple of crucial pieces of framing before we move to argumentation. I think the first thing to consider here is that the financial institutions will exist in both worlds. This is to say, it's not like on up we'll just have a world of communes that don't pollute. I think largely global financial markets will exist in both worlds. We are merely talking about whether we should account for climate-based risks in the valuation within this world. With that, I think there are two types of risks that we actually want to account for. The first one is based on natural disasters and sort of the direct effects of climate change. That is to say, if you perhaps run a forestry company, but your forest is prone to burning down because of climate change, then this will be a risk that will be accounted for. The second type of risk is policy-based. That is to say, I think we can anticipate major global action on climate change within the next couple of years, much more so in some countries than in others. Thus, if you run a coal mine, it is likely that you will face regulation in the near future, and that's something that your valuation should also account for. With that, what are the financial institutions that we will be talking about? First of all, it's investment banks, which have to always consider the riskiness of assets and the valuation of assets when they are underwriting them. That is to say, when they are issuing stock for companies or underwriting their bonds. Secondly, it's credit rating agencies, which actually assign sort of ratings to companies that determine how risky their assets are. That is to say, if your company has more risk associated with climate change, it will receive a lower rating from these agencies. The third type are investors, especially institutional investors. That is to say, we also sort of want hedge funds and sort of pension funds to take this into account when they're making investments. I think that's natural because they are always their valuations are always based on investment banks. Okay, so then what is our argumentation in this round? First, I'm going to talk to you about how this supports adaptation and mitigation to climate change. Secondly, how this actually protects us from market bubbles. Okay, so on the first point, I think what largely happens here is that we shift corporate incentives. Let me explain how this works in the present term. Currently, companies are generally run by boards presided over by a CEO. These boards are elected by a meeting of their shareholders. That is to say, the people who actually select who runs the company are the people who care about the stock returns. They care about the stock returns in the present term because they often, buy a stock and they are looking to sell it in a couple of months. They want the price of the stock to rise within those couple of months. That is to say, it is definitely in the incentives of the CEO to keep the stock price of the company as large as possible. Unfortunately, this is very much short-termist because a lot of these investors make short-term investments and those CEOs are sort of selected for only a year or a couple of years. With that, it is often not in the interest of the CEO to actually invest in climate mitigation and climate adaptation technologies. That is to say, if you are running a business that is potentially threatened by climate change in the next 10 years, but your incentive structure only reaches within the next 2 years when you care about the stock price, you will likely not invest in, for example, expensive technologies that make it easier for you to handle climate change or that make sure that your company actually produces less emissions. Why? Because, well, you want to maintain the stock price as high as possible. That is to say, we think there is a distortion in the current markets where they don't account for the risks created by climate change because those risks are often, fairly random and fairly long-term in nature. What we do on our side is that because sort of investment banks and because credit rating agencies will automatically account for these risks, they'll be included in the stock price right away. That is to say, if an investment bank says that a certain company is very risky, then investors will naturally move away from it, the stock price will fall. Before I will tell you how this leads to changes, I will take OO.
Yes. Why do you think that this should be mandated? Why shouldn't there be an opt-in policy? Let's say some credit rating agencies following these risks and calculating them and some not, especially because all investors may not care.
Well, we think that all investors should care, and I will tell you what sort of distortions this causes for other people than the investors. But also, I think if we prove that generally this is a good thing, then it's better if all credit rating agencies do it than if only some of them do it, so that there aren't conflicting opinions on this and investors don't get confused. Anyway, what actually happens is that we encourage the adaptation to climate change. We encourage these people to actually adopt those technologies because those will be reflected in their stock price. As long as you buy the more expensive technology that allows you to survive climate change better, your stock will be deemed less risky by the credit rating agencies. I think this is great for two reasons. First of all, it protects shareholders. Second of all, it protects customers. That is to say, even the customers of these companies who are, for example, buying food from a company that uses fields that are especially prone to extreme weather events, then there could be disruptions to the supply chain, and millions of people around the world could see the prices of everyday products increase, or they could see shortages. This is especially true in the developing world. Since we encourage companies to actually adapt and to lower the risk as much as possible, we think we protect these people. Now, onto our second contention about how we actually protect the shareholders as well. As I've already established, the current market doesn't really take these risks into account, even though they are very much real and they very much exist. The main reason for this is simply that this is often not something you can directly predict causality. That is to say, you cannot say the concrete extreme weather event was caused by climate change, but you know that climate change does generally increase the probability that this happens. That is to say, we think that there are currently bubbles in the market where there is simply too much capital invested in stocks that are too prone to climate change risks, either due to policy and regulation or due to extreme weather events. What does this mean? This means that in the future, we can probably anticipate that when some of these extreme weather events happen, these stocks will take massive hits because suddenly the company's profits will go way down because they were, for example, hit by a forest fire. I think that's pretty bad because surprises are actually horrible for the market. First of all, many people bank their retirement savings on the market, and if those people are just about to retire, then the retirement savings reducing in value to 1.5 is something pretty bad. That is some pretty bad social consequences, such as those people being poor when they are old and sort of their entire life savings disappearing. I think we should prevent that as much as possible, and we should care about it as the government. But secondly, I think that even if you care about the overall economy and you care about the numbers, then surprises are pretty bad. Why is that so? Because the markets actually take time to adapt. That is to say, often if there is a negative surprise, that is to say a certain company, for example, goes bankrupt because of an extreme weather event, then those workers will be laid off, but it will take a lot of time for them to get retrained. It will take a lot of time for them to get rehired. That is to say, even these events can have very much long-term consequences on the welfare of everyday people. Thus, if you care about the markets themselves, if you especially care about the shareholders who put their life savings in those markets, and also if you care about ordinary people, you should vote opening up. Thank you.
Thank you very much, the Prime Minister. We are ready to call Leader of the Opposition. You are still muted.
Sorry. Can you hear me now?
Yes, all good.
Sorry. Great. I'll take PYs in the chat. I'll try to take 1 before 6. Yeah, that's it. As much as we'd love to say that the environment is extremely important, and we do agree that to some extent we have to be able to protect it, notice that you are unable to do that the moment that you deprive these individuals and these companies and countries from economic development in order to do so. Because notice that this policy doesn't harm the top 100 companies or the richest nations of the world that are already doing things like transitioning to green tech because they had the capability to do so in the first place. This is likely going to harm those countries that are more likely to be affected by things like economic recessions and are likely to do things and are likely to be able to need these kinds of financial institutions, or newer companies that are starting out that still need to be able to be stable, to be able to have CRAs vouching for them. I think the clear comparative here is that I think that on their world, they never prove the mechanism as to why they're likely to change anything or why it's likely to be impactful in multiple ways. I think that the burden of this motion isn't for opposition to defend a world where nobody cares about these kinds of standards to begin with, but why it shouldn't actively be integrated and why it shouldn't be all of these kinds of SRAs or things like financial institutions. What does our world look like? I think number one, it looks like how we already do account for economic impacts, if it, like environmental problems, if it does have economic impacts to begin with. So, for example, if you live in a country like Saudi Arabia, for example, or you're a largely oil-dependent country, the fact is that because oil is scarce and it does lead to some economic impacts like inflation rates, for example, or higher prices in goods in some instances, I think that's already accounted in the way financial financial institutions assess whether or not you're economically viable, and the way that CRAs assess it as well. So I think that in some instances, their problem is largely mitigable anyways. The second thing is we already do have to some extent an ability to be able to try to recommend or to try to enforce some of the environmental concerns that they have, like how S&P, for example, has this in some of their considerations, but it's not a major consideration like what government is trying to push forward in the first place. I think thirdly, there are financial institutions that are meant for economic development in the first place, like the Asian Development Bank, for example, giving loans entirely dependent on environmental, like doing things like setting up power plants in different developing worlds, for example, that aren't tied to the economic deals and economic loans that they could potentially get. I think these alternatives are enough to try to mitigate a lot of the problems that they pose without all the harms that we are going to posit to you in this debate. Before I move on to my three arguments, I first want to quickly rebut the previous speaker. I think the first thing that they assume is that when you do this, everybody will likely change the way that they are doing their businesses and the way that their countries have their industries right now. Number one, they didn't prove the capability or the incentive of these countries to do so. Maybe to the extent that they said that stocks matter, but never proved why financial institutions are the only alternative. Because notice that financial institutions aren't the only way that you can get these loans. If you no longer trust them, if you no longer feel like you can get a loan with them, you're likely to do things like move on to bilateral kinds of trades, which we argue is far, far worse. But more than that, I think they never proved why they had the capability in and of itself, given things like COVID-19 and an economic recession currently looming. They never proved why it's likely to actually happen in terms of the effectivity. I don't think they had the fiat to do that. Therefore, I don't think that they were able to prove a lot of the exclusivity in their arguments. Let's therefore go to my first argument, why we think that it damages the ability for countries to develop in the long run. I think that the problem here is that we restrict development for a lot of countries that do rely on these financial institutions or the CRAs to begin with. This is because when it becomes actively integrated, it becomes a requirement that weighs higher than it normally does right now. It's probably going to weigh higher than your actual economic output, for example, which is why we think that all countries that do things like invest in oil industries or have tech companies, for example, that are startups that do have to rely on less environmentally friendly like kinds of activities right now because they are likely to be startup companies. I think they're likely to not get loans, and in these countries they're unlikely to get the support from these kinds of financial institutions. The reason why this is bad is because notice that number one, given the fact that we are currently facing a looming economic recession, we need to be able to have these financial institutions to give us these kinds of loans for us to develop our own industries and to just basically keep people alive. I think that the alternative is never will people care about these kinds of environmental problems when their own economic safety is something that is being targeted. And if you don't provide them that, because obviously they can't change their entire industries overnight to be able to afford these loans and afford these kinds of restrictions to begin with, I think that's where you're dooming those populations. That's the practical harm of this argument. But I think the principled harm is, notice that a lot of the industries that are going to be affected by the specific principle are industries in the developing world, which naturally have extractive industries like oil because of colonization, because a lot of these Westerners made these kinds of institutions in those places in the first place, but because they aren't as rich and they aren't as rich like the United States that is able to do things like transition to greener technologies and greener alternatives right now, that they are the ones that are likely going to be harmed by this, like just because they were colonized into doing this, or they are less rich given the wealth gap in the world. I think that's why it's principally harmful in that regard. So the second thing that I'm going to prove is why we think that it removes the trust of it removes the purpose of financial institutions, because we no longer trust them as our alternative for economic salvation. I think when you actively integrate this, I think now you largely because economics is a very westernized concern, a lot of the countries that do face anti-Western sentiment right now will be against this. And I think largely because there's no social consensus on this value, I think you are losing that trust. And trust is important because notice that if you are a CRA, for example, your relationship with investors is only if investors trust that your ratings are valid and are actually about economics. Now that you shift the entire standard to include this bigger concern, I think now it no longer seems like it's an important economic insight, and you are likely to just not include it as in your decision making at the end of the day. I think this leads to two impacts. Number one, you're more likely going to not go to financial institutions at all because you can't avail for them or because you no longer trust them, and that's where you're more likely to do things like get bilateral trade deals with institutions like China, for example, that don't even care about these kinds of environmental issues, more so are likely to put you in economic more harmful economic conditions. But number two, I think in terms of investors, you're unlikely to now cater or even use these CRAs to the fullest, which is what happened during the Enron crisis, where we had lesser trust for things like the CRAs, and you're unlikely to do so. Now you're putting your money in places that are unsafe and are likely to topple down and are likely to be less effective. I think the reason why we solve all of these problems is because number one, now that we are able to now that we stick with status quo, number one, CRAs and financial institutions still have their power to be able to do things like make recommendations, which is what the ADB, IMF, and a lot of these CRAs are currently doing right now, because now there's still some form of trust because they don't feel like they were unfairly put into these standards, or that it's naturally or it's naturally pro-Western to begin with. That's where you're more likely to get these kinds of deals. Number two, we get to protect their economic viability as countries, because now they don't have to resort to more nefarious kinds of actors like China, but are more likely to stick with us, where we're more likely to regulate and assure their economic output. The final conclusion that you should get from my speech is quite simple: that the only time that we get to care about environmental problems is if we are economically progressive. If you cut that ability for them to be economically progressive right now, not only will they resent you, but they'll never care about these issues in the first place. Thank you.
I would like to thank the leader of the opposition, and I would like to invite the DPM to continue the debate.
Three, two, one. I think the problem with opening opposition is that they're very focused on the countries that are taking on loans, but we think that the way in which change happens is by engaging basically the top 100 companies that are polluting. And we think that in order for the environment to get any better, we need those particular corporations to change. That means two things in the context of this debate. One, we think that the institutions that they talk about, or governments in the developing world, are like the environmental standards for them is going to be far less weighed because they're like relatively less impacted, but also the impact that they hold on the environment oftentimes is lesser, as opposed to like multinational corporations that choose to pollute. But secondly, we think that in the long run, like in order for these countries not to be surprised when the eventual environmental crisis hits, we think it's preferable that they develop in this particular way, even if we accept most of their characterization. I'm going to talk about two things in this speech. First, I'm going to talk about environmental impacts and how we change that. And second, I'm going to talk about economic impacts. The main quibble, first for environmental impacts, the main quibble that opening opposition has is that, you prove to us why companies' incentives will change, but not necessarily why companies' capacities will change. Here's the thing. A lot of these companies already have the capital to invest in these things. Like if you look at BP and Exxon, it's not that they lack money to invest in R&D for the environment, but oftentimes the reason is that, as Matej told you, they necessarily have to be short-termist due to the distorted financial incentives we have in the status quo. And the issue is these capital already exists. It's only a matter of how you're going to utilize that capital. We think we get better utilization of capital under our side. The other thing opening opposition talks about is that, they say big companies have already transitioned and therefore they don't matter in this debate. This is factually wrong. A lot of big corporations are still trying to stick to the things that they've already done because there's a huge cost to transition that they don't want to pay, and they want to drag on the environmental pollution that they're doing for as long as possible. We changed that incentive under our side of the house. What kinds of transitions are we talking about? One, it means more research and development that integrates different kind of technologies that are going to be resistant to environmental problems, but also lead to less pollution. It means things like integrating more renewable energy sources if you're developing cars. Second, it oftentimes means safeguarding resources that you already have from like economic impacts. And third, it means like changing technology so that like if you're in an industry that engages in coal, you're going to lead to things like renewable energy. All of these things are impactful for a couple of reasons. And I'm going to give you the framing here. One, we would say that at the end of the day, you need to work with these corporations because they are the greatest delta and greatest impact changer. Like people could recycle every day, but that doesn't really amount to the kind of environmental impacts that these corporations have. And in the absence of getting these corporations to change, we think that you're going to lead to a society where far greater number of individuals are impacted because they don't have places to live, or far greater number of individuals are impacted because they have lost their jobs. We think these are things that, like opening opposition, if they care so much about the economy, we think think we're like outweighing them here, because in the absence of the environment, in the absence of companies being able to adjust to the environment, you just cannot get the economic benefits that you're talking about, and like the economic benefits just aren't sustainable in the long run. But second, we would say that you actually need companies to change now, because the issue is, at the end of the day, the environment is getting worse every like each and every day, and at some point you're going to have to stop using coal. At some point you're going to have to stop using oil. So it's actively preferable when they say like, oh, like companies that like use oil or like extract oil can't get loans. Like we think that's actually a good thing, because you actually force these companies, whether it be like BP or Exxon, or whether it be like smaller companies in the developing world, to change the like corporate incentives that they have and the way in which they make money. That means that if you change later, like the kind of surprise elements and all of the harms that they're talking about are still going to accrue. We think that we mitigate a lot of the harm by changing things in advance. Finally, opening opposition talks about how like newer economic institutions or extractive institutions in the developing world are going to be harmfully impacted as a result of this. One, just because you are engaging in these practices due to colonial reasons does not necessarily mean that these extractive institutions are a good thing. In a large number of cases, like extractive institutions or like oil companies in the developing world are actively harmful to local individuals because they pollute the like living standards and lower the living standards of people on the ground. We think that there's an active reason to prevent them. But secondly, we think that these companies will get more capital in the long run if they like adjust to like more climate resistant tech, because in the absence of that, these companies are going to be left behind. And the issue is, when 20 years from now, a lot of other companies might have moved on, but you're still engaging in an industry that has already failed. We think that they are the side that's actually dooming the developing world and the companies in the developing world to an industry that cannot an industry that we need to move on from at some point. I'll take a POI from closing if you have anything.
Yeah, why leave this up to investors? Why not just regulate or ban these horrible industries?
Like you could do that too, but like the issue with regulation is that there isn't that much of a capital. We think that we provide the most direct link, because investors are the things that corporations care about the most, as opposed to like regulations that corporations can't escape all the time, and governments don't have incentives to legislate. So we think we provide the most direct path to change. Moving on to economic impacts. Opening opposition talks very briefly about like how this can be an opt-in policy, and companies or like credit rating agencies can still consider this. Here's the thing: no credit rating agency or financial institutions has an incentive to account for this, because one, other institutions aren't doing so, but two, you choose ratings based on what companies are doing and what companies are motivated by. If companies are not motivated by the environment, presumably you don't have an incentive to consider that. Here's how we change that. Under our side of the house, we fix for the market distortion that exists in terms of the economic impacts, the environmental impacts that come as a result of climate change. That means that individuals like shareholders or individuals who are like related to the financial industries of the corporations under our side of the house are far more likely to be protected, because the stock prices that you buy or like the bonds that you buy are more accurate under our side of the house. Now, this is not just about like the top 1% of investors in Wall Street. It's literally about anyone who like trades stocks or who is like put money in a retirement fund. And here's where we're going to weigh against the opening opposition claim about the average individual, because under their side of the house, if the bubble bursts, and Matej told you that the bubble is inevitably going to burst at some point, the like large sectors of the economy is impacted, and there's like additional impacts that come from like the bubble bursting and like the economy not being able to function. Under our side of the house, we create a more accurate market price, and therefore the average individual who is engaged in this is, one, more likely to be protected, but two, isn't going to be harmed as a result of unprecedented market changes, and therefore we think we protect these individuals better too. Very proud to propose.
Thank you very much to DPM, and it's time for DLO to close the debate on the top half.
Hello, can I be seen and heard?
Yes, all good.
I won't be looking at the chat, so POI me around the 5th minute mark through voice channel, and I'll take it. I'm also keeping my own time, so I'll know when it's 5. I think OG is quite out of this debate because they don't seem to understand the context in the world we live in. Because take note, the wording in the motion says actively include, which means that there is a presumption that we are already accounting it to some extent. And I think that's true also given the matter that that credit rating agencies like Moody's and S&P do already take it into account. It's just a small margin, i.e. they take into account the risk factor of the likelihood of you being flooded such that there is a risk of your company losing in stock value because you might be flooded because of your practices. So there is some extent of risk analysis that does already exist on status quo. The difference is whether or not we should actively do it. And the fact that PM couldn't even explain to us what actively looks like, it is only fair for my partner to be able to tell you that actively probably means having all credit rating agencies and all financial institutions take it into account. Having actively means that it plays a significantly larger factor compared to original factors such as actually just calculating risk on its own. So I think that given that piece of framing, I think a lot of the things that OG says are value neutral or non-comparative, given that it already occurs on status quo. But now let's move on, because they say in the only response I give to my partner, because my partner had so much more to give than what they responded to, was that the debate doesn't talk about countries because countries don't matter and it's the top 100 that have to change. I think, first of all, the reason why that's unresponsive to my partner's speech is my partner's speech wasn't to say that the biggest polluters are the poor, right? Her speech was meant to say that if this policy exists and it is an active account in all instances, whether domestic when it takes into account companies or international when it takes into countries, the one it punishes the most are those who are already in the back end. Third world developing countries who already have low credit rates to begin with because they are the ones most affected by climate change, because they have instances like corruption, but now are worsened because these are the same countries that do have bad environmental practices because they have the inability to shift to begin with. So it's not to say that these are the worst polluters, but rather to say the policy in of itself harms people more vulnerably compared to the people that they are attempting to change. And given that there was no clear change mechanism aside from a monkey see, monkey do, then I don't think that is a valid claim into this debate that they can actually get tangible change. But I'll get more to that later on. But now, why exactly are the top 100s not really part of the debate? I think that, first of all, my partner already told you they are moving to greener technologies. And moving to greener technologies doesn't just mean the top 100 companies are the ones moving to greener technologies. It means the companies that are not shifting to green technologies are also getting bumped out of the list. That's why a lot of new IPOs are being entered into the list, and IPOs who are environmentally sustainable, such as Airbnb or examples like Elon Musk and Google, who are investing in green tech. So that means the top 100 isn't stagnant. So the top 100 companies do shift. And that's why, so when we talk about the top 100 companies, there is a shift already in going green or investing in green tech. But if it's companies like H&M or BP, I think that that's the reason a consumer market also equally exists. Boycotts exist for the reason of environmental concerns, and investors don't want controversial issues. So I think that if their concern is BP, then I think there are already there are market mechanisms such as boycotts which move investors to want to invest in it in the first place. The burden they had to prove why specifically through credit rating agencies do they have to do this. But lastly, even if CRA later, it's not yet 5, they have the existing reputation anyways as well as a permanent consumer base. The same way Facebook has all these ethical concerns, but we still use them. Investors are likely to pull out as a basis of the environmental concerns if you're correct in saying that no one cares. The conclusion here is essentially what happens on government side, aside from putting those at the back end in a more vulnerable position, is that you remove the trust in credit rating agencies. And I think this was something that was largely unresponded to by Deputy, because my partner told you that the power of buy-in is the sole power of these institutions to begin with. Because take note, these institutions do not have enforcing power, do not have the capacity to create big changes. The most they have is the trust of the investors, the trust of the countries who are buying into them. What's an example? If you take a look into the international community, because we've seen a trend of the IMF and World Bank requiring environmental regulations, that's what led to the rise of the rise of the Asian Infrastructure Investment Bank, which was the alternative of China, which was willing to disregard these environmental changes, all in the sake of being able to give out loans. And people shifted towards that simply because they didn't trust the IMF and World Bank to begin with. But if you look in the domestic sphere, because of the 2008 financial crisis, which eroded the trust of the people, that's why a lot of private hedge fund managers started popping up, which means that when we talk about the trust that is in these institutions, because it's eroded, the impacts they didn't respond to two coming from my partner is that one, you lose what little control you have on these people to begin with, which means that if we had some level of accounting for the risk, we lose that completely because these people are unwilling to listen to us or are likely to look for alternatives to begin with. But the second impact, and which also wasn't responded to, was that these investors are these credit rating agencies and financial institutions have the capacity to make policy advisories. But if they do not have investors who are backing them or investors who are following them, they do not have the legitimacy to push forward for these policies. So when they go to BP and recommend that your stock prices increase when you shift to greener energy, then BP is likely to listen when he knows that credit rating agency has a lot of people who listen to him. But if the credit rating agency has no investors following them, then BP says it's probably not true. It's probably not going to affect them anyways, because whatever they say doesn't matter. But before I move on, I'll take whoever gave the POI.
Sure, I can go. So if you're saying that you support things like boycotts of oil companies, then those will also disproportionately harm those in the developing world because they don't have the pollution mitigation technology. Why can you support those and oppose our policy?
Okay, when it comes to boycotts, and I think the difference is marginal here, is because there is an already existing understanding. People do have an existing hierarchy, which means that companies like BP, because they know they have the capacity to change, are likely to boycott that. But for people who know that smaller countries or smaller companies do not have the capacity to change, they're unlikely to do that in the first place. But the difference is it's not only about credit rating, but it's also about loans as well. So when you talk about the willingness to give loans, you can also choose not to give loans to BP because you know it's harmful, or you can choose to give loans to small you can choose to give loans to smaller companies as well. So there is an evaluation of risk that happens at the end of this debate. So what essentially does opening opposition bring to you in this debate? Opening opposition does a much better job than the narrow debate that OG set up for you. Opening opposition says that this debate takes place in two places. It takes place in the international sphere, and we talk about how credit rating in companies and how financial institutions affect smaller countries and how the policy further worsens the case for them. But secondly, we talk about it on a domestic level and how this policy further pushes away the trust people have in financial institutions and credit rating agencies, such that it is much more difficult to get change on the ground. Very proud to oppose. De La Salle is moving to the finals.
Thank you very much for that speech. And we are ready to open the bottom half of this debate. And I would like to invite a member of the government to continue.
Okay, just to check, am I audible?
Yes, all good.
Okay, give me a second, please. Okay. So the first thing I want to point out is actually the motion. The motion says financial institution and credit ratings. Like, it doesn't say Western financial institution. It doesn't say US-based credit rating system. So when talking about this motion, I don't see any reason why this would exclude majority Chinese-funded banks and so on. Like, we are talking about all institutions using this mechanism as an alternative. This is why this is a debate. Okay. I think that's pretty self-evident. And one more thing where I want to first clash with the opening opposition, like their entire point, today they sometimes take into account, sometimes they don't. What we believe is a far better system is when you have a unified system where everyone takes this realistic risk management into account when we're giving their credit score or giving their loan. This is far better. The thing is, and this is important framing here, that individual companies, whether they are middle companies or even when it comes to the largest companies, do not always have the ability to predict the way things will unfold when it comes to the risk of climate change and so on. This is because, not only because they are in the short term, but also because in different fields, they simply do not have the specs knowledge that is needed for these sort of things because it's massively complicated. And secondly, like, because in the short term, it would put them in a bad market position because their competitors would not behave in that way, which would drive down the price of their stock. But now I'll move to our points. And before that, I want to just point out that we will beat opening opposition when it comes to developing countries, and we will prove to you above opening government why, when it comes to climate change, this is actually like really important. Okay, so our case, when it comes to the economic side, is quite simple at its basis form. We think that credit ratings, adequate risk assessment is very good, not only for the party that is borrowing the money, but also for the party that is getting the money. This is very important for developing countries because they do not have that much of a margin to get into a deficit. They do not have like that much of a faith from international actors and so on. So when they borrow, it needs to be based on good risk management. And pretty much every team so far agree that climate change is a really important thing and that this is something that is objectively true. So we tell you, when you take into this account and when developing countries borrow money, it will be based like on objective criteria, on an objective projection of how their economic position will change in the near and in the short, in the far future. Why is this important? It is very important because when you borrow above what is realistic, you're putting yourself in a position where you have more loans than you will be able to pay off. This is devastating when you're a developing country, because when you take on too much, when you take on more debt, even if in the short term it gives you more capital, in the long run, if you default when the next economic or climate crisis comes, you will be in a position where it will be extremely hard for you to pay it back. You will not have the support from international actors. You will be in a very bad position where it will be very bad for you to get out of it. You don't have the capital, you don't have the ways to actually do it, you don't have the negotiating power to work with international entities. Even when it comes to countries that are not in that bad economic position, when they go through this process, it's usually devastating. If you want an example of this, look at Greece. It's very simple. Greece borrowed above its means using a better than realistic credit rating thanks to the euro, and it was in a position where it is not able to pay off its debt. It has to restructure. It's a devastating position for Greece. So this is not something that benefited Greece. This was not something that would benefit countries of Africa or South Asia or so on. This is devastating for them in the long run. Okay, that's the first point, why it's bad for the country. Why it's bad for the banks. When you're a developing country, you don't have a booming financial sector. You have at best a couple of banks that function well enough to borrow and lend out money. But those banks usually borrow money by themselves and they lend it out. If those banks use a bad risk assessment when giving out loans to companies within a developing market, it means that when the crisis hits, they're not going to be able to repay those loans because the actors that took out the loans will mostly be bankrupt and will default. This means the following. Now the banks in developing countries do not have the capital. They are going default. They need support. They're not able to give out loans, which is a disaster because at the time of crisis, you need actors to give out loans to the small amount of businesses that can actually invest in the economy, which and that would not happen. And since these developing markets do not have this massive international faith in them or support, they would not be able to get the capital needed from outside sources. So we are actually harming their financial sector with this bad risk assessment. The same thing goes for companies in developing countries. If they get loans from bad risk assessment, they're gonna borrow over their means and they're not gonna be able to pay it back, which means that when worse times hits or when a climate crisis hits in different ways, they're going to be in an awful position where they're going to default and not actually be able to stick it in the long term. These are the reasons why for developing countries especially, and for the broader economy, it's this is necessary. Simply, it's a realistic credit assessment. This is why we go over when it comes to the economic point. And I'm going to talk about the climate point. The current problem with the way we view climate change globally is that it is something that is very abstract, something that it's hard to quantify, something where companies and other actors can simply cast doubt and so on. And this is contributing to the fact that we're not doing as much as we need as fast as we can. But when these sort of climate factors realistically come into the way, to the credit rating of countries, to the credit ratings of their largest companies and so on, then people and companies are in a position where they can realistically see and know how much in the future they are going to have to pay and how much of a burden climate change actually is. And this is important on multiple fronts. Like firstly, when it comes to like public discourse all over the world, now it's like a much bigger deal because there is a way you can quantify. You know that the wages in the future are going to be less because of this, and this makes it a lot more easier for politicians to get to fight for policies that benefit this. But also, when pretty much every company is hit by these sort of things, it makes it far more likely that a lot of companies are going to lobby for better climate change policy because they know that in the long term it is going to benefit them, their credit rating, and their bottom line. Dear panel, like we go over the opening themes both on economy and both on climate science. I thank you.
Thank you very much. And we are ready to invite the member of the opposition to open the case for closing up.
Can I be heard?
Yes, all good.
Okay, I'll start in 3, 2, 1. While we care about development and we love the developing world, and we're going to talk about development later in this debate, we think what's been fundamentally missed by a lot of sides, particularly our opening, is the environment and where it is better. Because while we think that development is important, people's livelihoods are important, frankly speaking, cash is useless when you're dead. Because the climate crisis is an existential crisis, often disproportionately affecting the lives of people in the developing world, for example, because they're low-lying, for example, because they cannot adapt to flooding, etc. So let's talk about then sort of what the biggest thing we think was missed in this debate. And I think lots of people have actually forgotten, that credit rating agencies are shit. It's only been 12 years since the financial crisis, and we have to understand that credit rating agencies don't actually improve people's information. Why? Because the incentive structures don't give way to truthful sort of credit ratings. And let's understand how that is so and what their incentive structures are. Firstly, we have to understand where they get money from. These are private organizations that are often based on issue payment. In that, the more companies come to them, the more they are likely, the more profits they make. So they base their profits on how many companies come to them. But there is not just one credit rating agency. There are often multiple credit rating agencies, and there's obviously a direct competition for the consumer base, for example, companies to get to them. And that results in two distinct things. Number one, there's the incentive of companies to go to the most favorable agencies that don't punish them too much for example, having risky investments. But secondly, on the flip side, there's a profit incentive of these organizations to pander to lenient standards to get companies to come to them. This means that the need to sustain business and the profit motivation of credit rating agencies means that they're likely to pander to the most favorable standards of these companies to give their stocks good credit ratings, often even though they're doing lots of environmental damage. This is why, for example, lots of companies got away with selling poor loans as subprime mortgages, poor investments to people, because credit rating agencies wanted to keep them around, wanted to keep their business, and thus there was a race to the bottom. That's why we can't trust them. So what does this do then? This not only means that you don't fully understand the risks of your investment, but you're often actively misled. And this often, for many actors, actually improves their image. So, for example, ExxonMobil can actually use credit rating agencies by favorable credit raters to improve its image. And we think this is important because we think that there are lots of socially aware and environmentally aware investors who are now given false confidence that their investments are actually being put to good use, and are being swindled into horrible investments, into environmentally damaging investments. We think that on a comparative, in a status quo where they're not going to credit rating agencies for this sort of information, they're likely to go to other people, like, for example, environmental groups, like, for example, environmental organizations who don't have active conflicts of interest. So, for example, we know that ExxonMobil is bad because we've been told by environmental organizations because they've researched on it. Now those environmental organizations are crowded out by these sorts of big credit rating agencies that have lots of capital to compete with them. Now, let's understand then how people are misled. People often then won't also notice that they're being misled for a variety of reasons. We think there are 5 key reasons. Number one, we think that often their investments are in far-flung areas, for example, the developing world, and they don't directly experience the impacts of these sorts of damages. Secondly, it's often hard to quantify the sorts of harms. So even if people report them, you can very easily plausibly deny, that's not that much, because again, these are very hard to quantify. Thirdly, there's a time horizon in that lots of these harms actually come out much later. Often there's a disagreement as to the risk of, for example, investment, and that sort of ambiguity can be taken advantage of by lots of these credit rating agencies to make sure that people can't call them out. Lastly, we think that lots of these credit rating agencies have access to lots of financial capital. They're able to, for example, invest large amounts of money in advertising. And all of these sorts of issues are extended in the developing world, where you, for example, don't have enough data, where you, for example, don't have strong credit rating controls. We think this is also true in the developed world, where you have special interests who actively lobby your government. We think that what happens then is that you have misinformed consumers who actively invest in worse places with a false confidence that they did not have before. Now, furthermore, we have two more things on development. Firstly, why is this bad for investors, and why do they make worse investments? We think, firstly, what happens now is that lots of investors don't actively go to credit rating agencies, and we posit and directly contend with the sort of characterization that opening government gave. Opening government says, oh, you want sustainable investments as an investor. That's not necessarily true. I want to flip a profit. I don't care if my investment is stable for 30 years. I'm probably going to flip it over in a year or two. So I only need to see the short-term investments, the short-term profit of it, and it doesn't necessarily need to be sustainable. So they often, for example, will ignore these sorts of ratings because they don't particularly care, because they don't give them information they need. The problem then is that they're likely to operate without information, often, for example, from sales pitches that aren't vetted, and often make investments based on instincts. This has two distinct problems. Number one, you're likely to put in risky investments that are likely to result in large amounts of losses. These losses aren't just personal to these investors, but they also sink companies themselves. You have less, for example, efficient allocation of money. Money goes to less efficient, worse companies that are not sustainable. Secondly, we think that often lose confidence in the market and invest less. So again, market efficiency is less, you're going to have fewer jobs, you're going to have fewer investments. Lastly, an argument about the developing world and why that's worse off. And we sort of make it distinct from opening in the sense that it's not just about the nature of the economies, but also who foots the bill, and there's a moral issue there. In that, developing countries who can't adapt to climate change and are at most risk because they can't, for example, again, adapt to, for example, flooding. They're often very low-lying, often they have large amounts of temperature changes, and they can't diversify their economy, for example, to move away from fossil fuels. These sorts of at-risk countries who are now going to foot the bill because they simply cannot shift to green energy. They can't afford green energy. They can't afford R&D, and there's a competitive advantage directly for developed countries. We think that the issue there is a moral issue, in that developed countries who have developed through the exploitation of oil and natural resources and are the direct cause of most climate change that has happened historically, most environmental damage that has been done historically, because they were the ones who were producing more. They are forcing developing countries to foot the bill of their damage. We think that that's a fundamental moral issue, and it results in two distinct things: a direct exodus of money from the developing world, but also the developing world footing the bill for others' crimes. We think that's a moral hazard. For all those reasons, we urge you vote closing opposition.
Thank you very much to the member of the opposition. We are ready to call the first whip speaker of this debate, the government whip.
Am I audible?
Yes, all good.
Great. Three, two, one. I think we have a rather simple position in this debate as a cozy government. We always tell you, rating agencies and banks and everyone who is assessing risk should take objectively most accurate as is possible risk of environmental and like natural disaster, things which could happen because of certain investments or their potential to happen in the status quo. Note, we don't want to overemphasize them. We just want them to be realistic. How mathematically probable they are, they should that much impact the rating. Nothing more, nothing less. Why believe that this is important? I think Novak gave a multi-percent. Can you please mute yourself? Firstly, because it's extremely important for people who lend out money themselves to know what the money they're getting, to allow them to have actually good perspective on what kind of risk they're making. If a country wants to loan money to build a power plant, which is going to create a natural disaster, or probably could poison the river, which is the main water source for the agriculture in that country, which could later create a huge migration to the cities, economic instability. They should probably be aware of that risk, and they should probably be able to have access to these kind of agencies, which would help them in this. Do that they should be doing, should be done, only because of that. Even if like these things should doesn't, for example, increase global warming or something in global scale, even if they might just hit a single area, if still that they should be aware of that, we should prevent those kind of investments, because in the long run they are both economically and environmentally hazardous and dangerous for that people, and in the long run they create more harm than good. Thus, they should have a bad rating for it, because they probably aren't going to pay off and create more trouble in the long term. Now, about opening the opposite list. They first to tell us that this is not exclusive thing. That's going to be done. No, they're probably not exclusive. There are other things which do this thing also, but they don't have a precise substitute. This is something that should really help us. We live in times of great urgency to tackle these kind of issues, which probably means we should use all means which we can. As Novak showed you, this helps actually with these things. So I really don't see why we shouldn't do it, especially with the harms they give. Firstly, they tell us there are going to be no loans for the developing country. Very doubtful, because still there are still going to be a lot of loans which are going to be given, not for the return of the money purposes, profit interest, but because of the developmental agencies, global agencies, which want to help them. Secondly, they tell us you need like financial security to take a college. To respond to that, we're now going to actually connect financial security and ecology in a rather blatant and rather easily understandable way to the politicians, people in the power, people in those companies, etc. Because now those people can now actually see, and voters, if they see, okay, it's now we have problems, we can get loans to actually do something in our countries, we should probably be more concerned about ecology. Now those things of like economy and ecology is going to be interconnected. Later, they tell us that they're going to go to China because China gives free money, etc. No free response to that. Firstly, China is stopping giving free money because they're getting themselves in an economical slowdown. They're entering into probably a recession, especially with the COVID viruses. That they aren't going to give it out. Secondly, they can give money everywhere, especially because countries which are there in their sphere of influence, in which they're interested in their support, already getting money. Others won't get it if there is no interest for China, so we are at least going to get those countries. And thirdly, countries already know that this is a rather toxic relationship, that they are going to be abused, that they're going to actually have no interest in helping you, and that every country which take loan from China and that probably wasn't happy with it, already some kind of backlash because of it, so even the politicians don't want to do it. Okay. One more thing they tell us is that nobody's going to listen to this they ignore. I think Novak gave you a good example why people need these kind of things, why they listen, why people want to have protection of their investment, that banks are going to listen because they don't want to make a risky investment. They don't want to put money for example, in a company which is going to create a huge disaster, which is going to be a horrible PR for that company, thus meaning that company isn't going to be actually valuable as much as it is, thus meaning it can get its investment back. So they have a huge amount of profit incentive to actually listen to these things. Now about the close. They tell us you can't trust the rating agencies because of 2008. Multiple responses to that. First, if you're an investment bank, you're still going to listen to them because you need some kind of information. You still want to have a better picture of what's happening. That's you're still going to listen to them because that is much better than having no information. Second, there is huge amount of regulation which is being imposed since 2008, which means that these companies are much more regulated, much more watched for. Thirdly, there are still environmental organizations which are going to actually show you that, okay, this is not true, this is a lie, which means there's going to be huge backlash and huge PR disaster, which means that these companies don't have incentive to do that. And if they do that, we have a watchdog who can actually prevent this. Fourthly, a huge amount of these companies are actually outside of the US, and those companies mostly have never been tainted, which means that probably you can trust them. And five, they want to protect their image, which means that they don't want to engage in things which are going to worsen their PR and their position in the market because their competition who aren't going to do this, which means that probably they're going to be listened. And sixthly, there are independent international organizations such as World Bank, MMF, which are going to do this same kind of things, which probably means you can trust them because they have no profit incentive. Okay, they tell us this hard to quantify. It's probably not easy thing, but the econometric is to a certain extent exact science, and there are probably people who can actually do this to a better measure. If they're comparative, we're not going to do this at all, or we're going to do it to some extent with some certain of insecurity. It's still better to do it in a road in which you can actually account for this kind of risk. I'm going to take closing now. Opening.
If all you want is to be aware of the environment, the media is there. Our risk assessment isn't bad, it's just not about the environment. But since the environment is a Western concern and not all countries agree with it, would you rather they get loans from China or not at all?
I live in Serbia. We have a huge amount of air pollution, which is literally hazardous, and probably are going all to die from the lung cancer. Even if I not come from a rich country, I'm still very concerned with this issue. It's probably for everyone living everywhere in which there's a huge amount of pollution, a huge amount of these kind of problems. We are probably very concerned about it. about short-termism in incentives. Note, companies aren't really short-termism; they're profit-oriented. Like ExxonMobil, all this huge amount of companies have huge amount of money put in initial development of green technologies, but there is no incentive for them to actually start using them because they don't want to actually refurbish their factories, etc. Which means that they need to push for this. This is a great way of it to actually incentivize to do them. And about the point of is like poor countries can't migrate to green technologies. No. If we're going to create now a huge amount of market for these green technologies, means we're going to have much more providers of these things, which we're going to have much larger amount of companies offering services of migration processes, which create more greener technologies, etc. Which probably means that it's going to decrease the price of transition itself. Why is this extremely important? In two ways. Firstly, we have no other way to actually push for this kind of change, that we can actually never be to actually force like these kind of like poorer states to actually regulate these things and force their companies to use this kind of technologies. And secondly, it's very risky for the banks to actually give money to green technology researchers because they aren't sure if there's going to be a market for it. Now there is a huge amount of signal which is going to tell them you should put money. Because we're going to help poor countries not get disaster, because we're going to make much better in investments, because we're going to have much more stable economies. Because of all these reasons, vote government.
Thank you very much to the government whip. And it's time for the last speech of this debate. I would like to ask the organizers to turn off this screen